The world has nearly 180 currencies, but one of them dominates global trade, finance, and power, and that currency is the US dollar. Despite constant headlines about de-dollarization, the dollar still sits at the center of the global economic system. For decades, it has been the undisputed king, the central pillar upon which much of the modern economic order has been built. Its influence extends far beyond the shores of the United States, touching nearly every international transaction in some way. In recent years, you have undoubtedly heard the growing chorus of voices predicting, or perhaps hoping for, the dollar's demise. This narrative, often termed de-dollarization, suggests that rising powers and shifting geopolitical alliances will soon unseat the dollar from its throne. Commentators point to new trade agreements bypassing the dollar and the ambitions of nations like China to elevate their own currencies. These developments are real, and they are significant. However, they often obscure a more complex and deeply entrenched reality. Despite the headlines and the political rhetoric, the fundamental fact on the ground today is that the US dollar's dominance remains remarkably secure and profoundly resilient. To truly grasp why this is the case, we cannot simply look at the surface-level chatter. We must dig deeper into the structural foundations of the global financial system. The dollar's supremacy is not an accident of history or a matter of simple preference. It is the result of a powerful confluence of factors built up over generations. These factors work in concert, creating a self-reinforcing cycle that makes the dollar both incredibly useful and extraordinarily difficult to replace. Understanding these interlocking reasons is the key to seeing the world's financial plumbing for what it is, rather than what some might wish it to be. The story of the dollar's continued reign is not a simple one of American might, but a more nuanced tale of networks, infrastructure, and trust. It involves everything from the way oil is priced to the way central banks manage their national savings. It is a system characterized by immense inertia, where the very ubiquity of the dollar makes it the logical choice for almost everyone, even for those who are actively seeking alternatives. Over the next several sections, we will calmly and clearly dissect the primary pillars that hold up this financial architecture, exploring why, for the foreseeable future, the dollar remains the one currency that rules them all. The first and most fundamental reason for the dollar's dominance is its role as the world's primary reserve currency. This is a simple concept with profound implications for the entire global economy. Central banks around the world, from Tokyo to Brasilia, hold a significant portion of their foreign exchange reserves not in their own currency, but in US dollars. These reserves act as a crucial financial safety net, a national savings account that can be deployed during a crisis, used to stabilize their own currency, or to pay for international debts. Holding dollars provides a level of security and flexibility that no other currency can currently match, making it the bedrock of global monetary stability for many nations. This reserve status is reinforced by the dollar's pervasive use in international trade. When a company in South Korea buys raw materials from a supplier in Chile, the transaction is very often invoiced and settled in US dollars. This practice is widespread even when the United States is not a direct party to the trade. The dollar acts as a neutral, reliable intermediary, simplifying calculations and reducing risks tied to less stable or less convertible currencies. This creates constant, structural demand for dollars from businesses and banks across the globe who need them for day-to-day international operations. Furthermore, the dollar serves as the default unit for a vast array of international contracts. From shipping agreements and insurance policies to complex financial derivatives, many legal and commercial documents explicitly name the US dollar as the currency of settlement. According to the IMF, the US dollar still accounts for nearly 60% of central bank FX reserves. It's on one side of almost 90% of global FX trades. The second pillar supporting the dollar's global status is the deeply ingrained connection between the dollar and the global energy market, a system often referred to as the petrodollar system. For the better part of a half-century, crude oil has been predominantly priced and traded in US dollars. This was the result of agreements and market conventions established in the 1970s. When a country like Japan needs to purchase oil from Saudi Arabia, it must first acquire US dollars to pay for that shipment. This makes access to dollars a prerequisite for access to the energy that powers modern economies. This pricing convention generates a massive, constant, and relatively inelastic demand for US dollars from every oil-importing nation on Earth. Whether a country is a political ally or adversary is largely irrelevant if it needs to import oil to fuel its cars, power its factories, heat its homes. It must participate in the dollar-based financial system, creating a powerful incentive to hold dollar reserves and maintain access to dollar clearing mechanisms. This extends beyond oil. Many other global commodities are priced in US dollars: copper, aluminum, wheat, soybeans. A construction company in Germany buying iron ore from Australia will likely transact in dollars. Fluctuations in essential goods prices are felt globally through the lens of the dollar. There have been limited moves by Russia and China to sell energy in their own currencies, but these remain small compared to the global market. The infrastructure for trading, hedging, and financing oil in dollars is extremely well developed with deep liquid markets other currencies lack. Dismantling the petrodollar would need a coordinated shift with huge logistical and financial hurdles. A third, and perhaps the most powerful, pillar is the unmatched size, depth, and liquidity of U.S. financial markets. The world does not just use dollars to buy things, it uses dollars to invest. When a foreign government, a multinational corporation, or a global pension fund has trillions of dollars to manage, it needs a market large enough to absorb that capital safely and efficiently. The United States offers such a market on a scale that is simply unparalleled. The cornerstone of this system is the market for U.S. Treasury securities, bonds issued by the U.S. government, widely considered the safest financial asset on the planet. The Treasury market is enormous and incredibly liquid. Investors can buy or sell huge quantities at any time without dramatically affecting the price. For central banks holding reserves, U.S. Treasuries are the primary asset of choice. Beyond government debt, America's corporate bond markets and stock exchanges are the deepest and most active in the world, attracting capital from every corner of the globe. From tech startups to established blue-chip companies, the variety and scale create a powerful gravitational pull for global savings that must flow through the dollar. Investors must first buy dollars to purchase these US-based assets. Because everyone knows US markets are the largest and most liquid, they become the default destination for global capital, reinforcing their appeal. An investor can easily sell US stocks or bonds and repatriate funds. They can't have the same confidence in many other markets. This unmatched liquidity is a formidable barrier to any rival currency. Building a market of this scale can't be done in a few years, or even a few decades. The fourth pillar supporting the dollar is a more intangible but equally critical concept: trust. Global finance runs on confidence. Investors and governments who place their wealth in dollar-denominated assets are making a bet not just on a currency, but on the long-term stability and predictability of the United States itself. They are putting their faith in the durability of its institutions, the transparency of its legal system, the independence of its central bank, the Federal Reserve. This trust, built up over more than a century, underpins the dollar's role as the world's ultimate safe haven currency. It is anchored in the American legal system and its strong respect for the rule of law and property rights. Foreign entities invest with confidence that assets will not be arbitrarily seized and that contracts will be enforced by a predictable and relatively impartial judiciary. Furthermore, the U.S. has a long history of maintaining relatively open and free capital markets. Unlike some countries with strict controls, the U.S. generally allows investors to move their capital with minimal friction. If an investor needs to pull their money out, they can. During times of global uncertainty, this perceived safety and ease of access leads to a flight to quality, where capital flows into US dollar assets. Paradoxically, the dollar can strengthen even when a crisis might originate in the United States itself. While the US faces challenges, it is still viewed globally as a bastion of relative stability in a turbulent world. It is important to acknowledge the fifth key point. Alternatives to the dollar are indeed rising. This is not a myth. China has been actively promoting the international use of its currency, the yuan, encouraging partners to settle transactions in local currencies. The BRICS nations have discussed creating new payment systems and reserve assets to reduce dependence on the dollar-centric system. These are leading to concrete actions, bilateral currency swaps, and initial forays into non-dollar commodity trading. These moves signify a genuine desire for a more multipolar monetary world, gaining traction in certain regions and specific types of trade. A growing portion of China's trade with Russia and with Brazil is now being settled in yuan or other local currencies, bypassing the dollar. Digital currency initiatives and new cross-border payment platforms are being developed outside traditional US-controlled plumbing. These developments are chipping away at the edges of the dollar's dominance and challenge the status quo. But the ambition to replace the dollar runs into the colossal force of inertia. Banks worldwide have systems built for clearing dollars. Traders have decades of experience in dollars. Legal contracts specify dollars by default. Changing this would mean rewriting contracts, rebuilding IT systems, and retraining generations of finance professionals, an immense cost and complexity. Therefore, even as alternatives grow, they face a steep uphill battle. In summary, the US dollar's commanding position in the global economy is not a fragile arrangement, but a deeply rooted reality built on several interlocking pillars. It is the world's primary reserve currency, held by central banks as a store of value and a tool for stability. Its foundational role is reinforced by the petrodollar system, which links the world's demand for energy directly to the demand for dollars. This is further amplified by the unparalleled depth and liquidity of US financial markets, the only destination large and safe enough for the world's capital. These structural advantages are cemented by a bedrock of trust in American institutions, the rule of law, and relative stability. Together, trade networks, deep markets, and institutional trust create a powerful self-reinforcing cycle. The system's very existence generates the inertia that makes it so difficult to displace. It persists not because it is perfect, but because it is functional, familiar, and for now lacks a viable full-scale competitor that can replicate its entire ecosystem. Even as the world becomes more multipolar, the dollar is likely to remain central to global finance for many years. The global economic system may evolve, new powers may rise, new currencies may compete. But for now, one currency still sits at the center of global finance: the US dollar. To navigate the world, you must first understand the system,